Okay, now we'll just quickly go through the extent and duration of the market halt and pre-open session is given below. Okay, so circuit breaker depends on what is the percentage change in the index and what is the time when the change takes. So if the change is 10%, 10% compared to what? Yesterday's closing. 10% compared to yesterday's closing. 10% of what? So if the yesterday Nifty closed at say 10,000, so today if the change is 10% means 1000 either plus or minus. And if it takes place before 1 p.m, the market halt duration is 1 hour. At or after 1 p.m. or up to 2:30 p.m, 30 minutes market will halt. And if it is at or after 2:30 p.m, no halt. Because now the market is open only for one more hour. Then if the change is 15% before 1 p.m, market halt duration 2 hours. At or after 1 p.m. or up to 2:30 p.m, 1 hour. On or after 2:30 p.m, so you should make it 2:30. The remainder of the day market will halt. 20% change, it's a big change. Any time during market hour, anytime if 20% is the change, market will halt for the remainder of the. Now just write here, keep checking these limits because the stock exchange keeps revising. SEBI revises this circuit breakers. So keep checking on stock exchange website because when you go to the exam, you again see whether these limits are same or has it changed. Okay, it can be for MCQ also. One point write down there, circuit breakers are not applicable for stocks. Circuit breakers are not applicable for stocks which are traded in the derivative segment. Which are traded in the derivative segment. If there is a Reliance future, then you will not have circuit filter for Reliance share. Okay. Second thing, write down, if circuit filter applies to one exchange, it immediately applies to other exchange. That means if the trading halts in NSE, because NSE has first shown 10% change, it will also halt in that BSE exchange also. Even though in BSE it may not have touched 10% movement. Okay. Then third point, write down, circuit breakers are not applicable for Circuit breakers are not applicable for securities which form part of index. Circuit breakers are not applicable for securities which form part of index. Where that particular index is traded. Where that particular index is traded. Where that particular index is traded. Suppose there are 50 stocks in Nifty and Nifty index future is traded. Circuit filters are not applicable to all those 50 shares which are part of Nifty because Nifty future itself is traded. Okay. So even though stock may not be traded in the future market, it forms part of an index which is traded in the future segment or option segment. Circuit filter is not applicable. Yes, throughout the day. For many other stocks. Yes. But for other stocks it is useful. Other stocks, those which are not forming part of derivative trading, it will be useful. Generally, those which form part of index or which are available for derivative trading, they are very good company. In their cases, the volatility will not be much. Do you have volatility of 20% on TCS share, Infosys share, L&T, Tata Steel, Tata Motors, HDFC? HDFC shares has gone down by 50%. 50. When did you hear that? He is a person who can certify. So, I don't think so. Even I don't think so. I am a shareholder of HDFC, so I have a little bit idea. Yes, bank. Yes, bank is different. HDFC is the best bank in the country right now. Anyway, so understood basically that basically this mid cap stock, small cap stock, they have lot of volatility. HDFC is the best bank in the country to my limited knowledge, whatever I have analyzed. And I have got one share of HDFC also so that I can get a balance sheet. Then I can use it for banking company final account teaching. Okay. That is my strategy. To buy one share and ask them for balance. Physical copy. Next paragraph, trading and settlement. So this is again an interesting part. How the trading and settlement takes place from the time you place an order, the time you receive the security in your demat account. There is a concept called rolling settlement. Underline. What is rolling settlement? Is basically settlement of transaction in stock market in a certain number of days after the trade is ended. So rolling settlement means settlement of transaction once the trade is agreed to. So normally in India now it is T plus 2 rolling settlement. Trading day or transaction day and plus 2 working days. So T plus 2 days is rolling settlement period now. Okay, within 2 days after the trade is agreed, the transaction is completely executed. The buyer gets the share, the seller gets the funds. Now, what is the timetable for rolling settlement? I will read from your book. The table is not appearing on the screen. Activity, description of activity, day and timing. So trading by the investor on T day. So let us say Monday. Once he does the trading and his trade is accepted by the stock exchange that yes, we hereby confirm that your 100 shares have been purchased. So you will receive a message from the exchange. After that, there is some back office work which goes on. Okay, because from your demat account or your bank account, the money has to move to other party's bank account, and from the other party's demat account, the shares have to move to your account. So nowadays, a lot of automation has been done, but still, for understanding what happens in the background, see, clearing. So there is an organization called NSCCL. What is the full form of NSCCL? National Securities Clearing Corporation Limited. Confirm the trade from the stock exchange. Then NSCCL processes and download the obligation files to the brokers. So that means they will inform the respective broker of the buyer and seller. This is your obligation. The buyer or broker will have to pay the amount. The seller's obligation, seller's broker has an obligation to deliver the share. Ultimately, on whom the entire obligation lies to ensure that things complete? The broker. Is it right? And this activity you have to perform on T plus 1 day, means on Tuesday. Suppose we'll assume Monday is the T day. So Tuesday you have to do, and that too by 1:30 p.m. So by 1:30 p.m. the clearing activity is completed. The respective brokers get the intimation about their obligation, and then settlement, pay in of security and funds to NSCCL. NSCCL gives payout of securities and funds. So funds and securities are first transferred to NSCCL, and then NSCCL will make payment of funds and the securities. This event will take place on T plus 2. Share do not directly go to the other party account. Okay, it is routed through NSCCL. And by what time these activities are completed? By 10:30 a.m. and by 1:30 p.m. So securities and payments, these obligations get over by 1:30 p.m. So total it took 2 days to complete this activity. Because of computerization and very advanced information technology, all these are now taking place automatically. Otherwise, physical doing transactions will become very time consuming. Lakhs and crores of transactions takes place on a daily basis. But still they monitor the system. Okay. Then now they have explained this whole thing in the form of a explanation. So first we'll start with trading day. What happens on trading day? Trading day, you can do the trading from 9 a.m. to 3:30 p.m. This is the present trading time. Morning 9 in your office, when you go, first thing you can do trading. Or till 3:30 you can do. Trading can be done on any working day when the market is open, except Saturday, Sunday and other holidays as intimated by the stock exchange from time to time. Very simple. During the trading process, one buys the share, other sells the share. After the execution of trading, the buyer receives the share and the seller receives money for the shares he has parted. But this will not happen today. This is just they are explaining that once the whole trading process is executed, the buyer will receive the share, the seller will receive the money. I think there is a small typing error here. During the trading process, one investor buys the share, that is correctly typed, and the other investor sells the share. Rectified if it is wrong, otherwise go ahead. Now next is on first day, day 1, T plus 1 day, what happens? T plus 1 clearing activities takes place. Clearing is a process of determination of obligation. You are a broker, every day you have so many clients who have purchased or sold the share. So your obligation needs to be determined first. What is your obligation? One, how much amount you have to pay. Second, how many shares you have to deliver. Is it right? So clearing is a process of determination of obligation after which obligations are discharged by settlement. On the T+1 day, that is one day after the trading day, first of all the NSCCL confirms the trade executed during the day from the stock exchange, which helps it to determine the obligation of each member. Now in this note, whenever the word member will come, it would mean the broker through whom the trading is done, to determine the obligation of each member in terms of funds and securities. After that, the netting of obligation is. Netting means what? Net amount to be received or paid, net number of shares to be delivered. That is explained below also. For the timing, netting means he has to pay also, receive also. Some of his client must have bought the share. Some of his clients must have sold the share. So net amount you have to receive or pay to the NSCCL. This entire process of determining the obligation is done by the custodian or clearing corporation, which works under the NSCCL. So there is a intermediary, we have discussed about them, custodian or clearing corporation, which works under the NSCCL. So this will help the NSCCL to determine the obligation of broker. Once the netting of obligation is done, all the files are processed and downloaded so that each broker knows what he has to pay in and receive. So there is an example on netting, oversimplified example. Suppose an investor buys 100 shares at rupees 2000 each on Monday and sells those shares at rupees 2500 each on the same day. So what is his net obligation in terms of funds and net obligation in terms of securities? In terms of security, his net obligation is nil. True or false? Because he has bought and he has sold. So net obligation in terms of security is nil. But what about his obligation in terms of funds? His obligation in terms of funds will be, he had bought at 100 into 2000, 2 lakh rupees. He has sold 100 into 2500, 2 lakh 50,000. So therefore he will receive a net amount of rupees 50,000. On the other hand, his net monetary obligation will be calculated taking into account his buying and selling amount, and as you rightly calculated, the net amount he will be receiving is 50,000. The pay in and payout of funds are calculated on T+2 day, that is on Wednesday. So on Wednesday, 50,000 rupees will be given to this broker, who will transfer it to the investor account. On the second working day, all the brokers has to pay in the required funds and security to NSCCL by 10:30 am, giving the required instruction to the respective clearing banks and members on the same day. Moreover, by 1:30 on the same day, brokers get the required funds through NSCCL, and this is called payout of the fund. When you pay, it is called pay in. When you receive the funds, it is payout. When you deliver the share, it is called pay in of security. When the securities are received by other party, it is called payout of securities. So by 1:30 on the second day after trading day, the payout is complete. Now they have explained pay in payout also. In case if you are interested, it is going to be very technical, so have patience. Pay in and payout of funds explained. Pay in of funds takes place when NSCCL gives the required funds to the clearing corporation by giving instruction to the clearing bank Now there is a clearing bank through whom the funds are rotated. Underline clearing bank. Paying of the funds takes place when NSCCL gives the required funds to the clearing corporation by giving instruction to the clearing bank, which credits the account of the clearing corporation. First, the clearing corporation will receive the funds from the party who has to make the payment. Clearing corporation has received the funds. His account is credited and debits the account of the clearing bank. This is called paying of funds. That means the buyer of the share makes the payment. So where is the money right now? With clearing corporation. After that, NSCCL gives electronic instruction to the clearing bank to credit the account of clearing member and debit the account of clearing corporation. This is second step where the funds are transferred from the clearing corporation account to the respective the clearing member account. So first it received the fund, then it made the payment from his account. This is called payout of the fund. When clearing corporation received the fund, pay in means make the payment, that is called payout of fund, and this completes the settlement cycle from fund point of view. Next is similar discussion, pay in and payout of securities. All this takes place at the background, you don't have to worry about it. Only for exam purpose, the NSCCL comes in between, takes money, gives money. When it takes money, pay, gives money, pay out. Same thing for security. Now it will take security, called pay in of security, gives security, payout of security. So pay in of security means when the shares that the shareholder wants to sell are picked up from their demat account, the seller's account, and transferred to broker's account. All these shares are delivered to clearing corporation. See, sellers sold the share from his account, broker, and from that transferred to clearing corporation. So what will you call it? Pay in of security. In payout of security, the shares that the investor wants to buy are received from clearing corporation and are then transferred to the buyer's broker account and then to the investor's demat account. After that, the shares are transferred from the broker's account to buyer's demat account. So what will you call it? Payout. A small diagram you can draw. Just very simple diagram. You don't need to draw all these graphics. Money, money, share, share. Okay. Delivering member transfers shares to NSCCL. So this is called securities pay in. NSCCL transfers shares to receiving member. That is called securities payout. And then one party makes the payment to NSCCL. This is funds pay in, and then NSCCL makes payment to other party, that is funds pay out. This way the cycle is complete. This diagram is very simple. Actual background office work is very complicated. I hope you have drawn. You can give the heading clearing and settlement. This transfer of shares takes place through depository. This part. The transfer of funds takes place through a clearing bank. Because shares are kept with depository. So the funds transferred to depository. So who are the intermediaries which get involved here? A clearing house or a depository gets involved here. NSCCL gets involved here. A clearing bank gets involved here. The two brokers gets involved here. Two investors on the two extreme ends are involved. Investor, broker, then clearing house or depository for exchange of share, clearing bank for funds, and in the center we have NSCCL who does all this settlement. Okay. Now come to one theory discussion. What is NSCCL, which we saw in that previous diagram? In April 1995, NSC set up the National Security Clearing Corporation Limited, its wholly owned subsidiary. So who set up this NSCCL? National Stock Exchange. What is its status? It is a wholly owned subsidiary of NSC to undertake clearing and settlement at the exchange. Okay, what we saw just now. So now that is responsible for all this clearing and settlement. It started operation from April 1996. So toward this year, NSC also started operation. NSCCL undertake the counterparty risk of each member and guarantees the settlement. So NSCCL ensure that the investor who buys the share receives the share, the investor who sells the share receives the fund. Settlement guarantee is a guarantee provided by the clearing corporation for the settlement of all trading of products in the stock exchange. Why people trade through stock exchange? Because you know that my transaction will be honored. Yes or no? That means there must be somebody who should ensure, guarantee that your transaction will be honored. That is the beauty of stock exchange. So who does this in our entire country? This NSCCL is the guarantor. And they have all the checks and balances, margin, money, etc. Organizations linked with clearing corporation in the clearing and settlement processes are. So who are the other organizations which are helping this NSCCL? A, B, C. A is custodian or clearing member. B is your clearing banks. And C is the depository. Then they have discussed about the function of this custodian or clearing member also. NSCCL takes trading information from the exchange and pass the trade details to custodian or trading members, clearing members. They are like an agent of this NSCCL. And then custodian confirms the obligation of the parties by netting. So who does all the netting calculation at the background? The custodian or the clearing members. Which broker will have to pay how much share, how much cash. And then they have appointed clearing banks. They act as a link between clearing corporation and clearing member. Each clearing member is required to maintain a clearing account with one of the clearing banks. So they have to maintain an account so that the funds will be transferred or received to clearing bank, and from clearing bank to NSCCL, from NSCCL to other party, and from other party to the investor. Okay. A clearing bank has to enter into an agreement with the NSCCL and clearing member and open clearing account with the deposit. Now what is depository? Already discussed at several places. Once again, they hold security in demat form for the investor in their beneficiary account. Every clearing member is required to maintain a clearing pool account with the depository. The clearing banks, on receiving electronic instruction from NSCCL, debits the account of clearing bank and credits the account of clearing corporation. This is called pay-in of funds and security. The NSCCL, after providing for shortages of funds and securities, sends electronic instruction to depositories and clearing banks to credit the account of clearing members and debit the account of clearing corporation. So this is again a repetition. They give instruction for transfer of funds. First it comes to clearing corporation, then from clearing corporation it goes to the members. That is, first when it receives, the clearing corporation receives funds and securities pay in, and when it gives to the respective member, pay out. Thus the settlement cycle is completed once the payout of funds and securities is done. Okay, so this is about clearing and settlement. A little complicated part because this is all happening in the background. Okay, we as an investor on the front will never be able to see what is happening. We are happy as long as we get the money or the share in our account. Now next is market making system. Why this concept of market making system has come? Suppose you want to sell the share, there is no buyer. Suppose you want to buy, there is no seller. Then through this entity or agency called market maker, you will be able to buy or sell the shares. Okay, so they are like taking from one party, selling to other. Market maker. Just like there are matchmakers. Boy and girl are matched by somebody. Okay, if they can't meet directly. So they are called market maker. The job of the market maker is to provide liquidity to the stock market by providing a two-way code. That is the buy and the sell. So how the market makers do this and what is the purpose? Next line. Now for that consider a situation. Why do market makers do this and how do they do it? When you want to purchase share and there is no one there to sell his share, then what will happen? Such a person has to wait until he finds a person who can sell his share at the price quoted by him. The market maker resolve this problem. He will sell the share at the quoted price. This way the person gets the share he wants to sell or buy. They should have written buy. Because here the story begins with he wants to purchase the share. Conversely, now this is also important. If you want to purchase the share and there is no seller, you can approach the market maker. Can I go to the previous slide? I can. Reverse. Suppose you want to sell the share. Now this is suppose you have share but there is no buyer for that share in the market. Market maker comes to his rescue and purchase share at the price quoted by him. So he get the share he was so willing to purchase. From the point of view of the investor, you should say he sells the share he was so willing to sell. Purchase price at the price quoted by him. Yes, of course by him only. No? You will say I want to sell this pen for 2 crore rupees. I will not buy. I will say this is the price at which I am willing to buy. So this is the price quoted by market maker. He gives two-way code. He gives two-way code. In the first line you read two-way code means he gives buying rate and selling rate. He says for this XYZ share, I am willing to buy at 20 and I am willing to sell at 20. So these codes are the code given by the market maker. So in case if you want to sell your share, you can sell at the price which is offered by him. The lower will be the price at which he would buy. Who will buy? The market maker. And the higher one will be the price at which he would sell. Okay. Hence, the market maker has devised a system in which anyone can buy and sell shares anytime. Market makers are basically large brokerage houses. But again, they have to follow the regulation. Okay. These are usually used for small companies where you have not too many buyers and sellers. But so how do they do the trading? They can do it through the market makers. How do they make money? Now, and the profit will be if they sell at a higher price and buy at a lower price. But the chances of loss is also there. Chances of loss is also there. Of course, if you are into share market, you are exposed to both risk and return. For example, if they buy share at a particular price, suppose market makers buy at 20 and is not able to sell them later at a higher price because of the fall in the market price of the share, they will incur loss also. So again, it is their calculation. Then your question will be, why do market makers enter the market? Because they deal in huge volumes. They deal in huge volume. These are large broker houses we have seen. So they buy say 10 lakh shares, 1 lakh shares. And what they do immediately after buying, they sell it at a little higher price also. Like this example says, he will purchase the share at 100 rupees and he will sell it immediately at 100 rupees 10 paise. So how much profit he made? 10 paise. But see, they are big broker houses. They know where to sell also. Is it right? Whose interest? Why is interest not safeguarded? Liquidity is less. That is why we are coming to the market maker. Again, if he wants to sell, he can again come to another market maker. Okay. See, practically this is not much in practice because I have really speaking never come across somebody doing it. But this is for small companies. This facility is. He will make money and I will sell suppose 10 lakh shares. So in this deal, he will make 1 lakh rupees profit. There will be buyers. They know the people. Suppose this Kumar Prestige Point 1 classroom is worth 5 crore rupees. Don't they sell? Yes or no? So there will be buyers. So don't worry. If you put Taj Mahal on auction, after 3-4 days you'll find buyers for that also. Your query. But this is Taj Mahal. That is why, na. Sorry, you don't. There will be buyers. For everything there are buyers. So normally you'll be able to know. There are mechanisms. There must be a mechanism of market makers also. That means SEBI may provide you a list of the market makers. If some system is there, it means it will work in some or the other way. Okay. Just like there are system of stock lending and borrowing mechanism. They have devised a system. You lend your share and the other party will do short selling. He will later purchase, return to you. So there is a system of market makers also. It works. Okay. And it is for very small company share. There that liquidity problem etc. will be there. Because they also are smart. They know that this share is worth much more than at what they are buying. So maybe they will stock it for some time and then sell it at a higher price future. But when trading of millions of shares take place in a day, the market maker at the end of the day managed to pocket a significant amount. Now, the obligation and responsibility of market maker as per BSc website, source is BSc website, and you can see there is a long list of conditions also which you need to fulfill to become market maker. Market maker shall fulfill the following conditions to provide depth and continuity on this exchange. The market maker shall be required to provide a two-way quote for 75% of the time in a day. So 75% of the time he has to say, this is the share I want to buy and sell at this price. The same shall be monitored by the stock exchange. Further, the market maker shall inform the exchange in advance for each and every blackout period. What is that blackout period? That is when the quotes are not being offered by the market. The minimum depth of the quote shall be rupees 1 lakh. So what is the minimum volume of trading? 1 lakh rupees. At least you should sell shares of 1 lakh to him. But then there is an exception here. However, the investor with holding of value less than rupees 1 lakh, I will say I have a share of only 90,000 rupees, shall be allowed to offer their holding to market maker in that script, provided that he sells his entire holding in that script in one lot along with a declaration to the effect to the selling broker. In case if you want to sell below rupees 1 lakh, then you can't do pick and choose. You have to sell all your holding. Okay, and you have to give a declaration that I have sold all my stock of that share. Execution of the order at the quoted price and the quantity must be guaranteed by the market maker for the quotes given by him. There would not be more than 5 market makers for a script. For one script, how many market makers? 5 maximum. These would be selected on the basis of objective criteria to be evolved by the exchange, which would include capital adequacy, net worth, infrastructure, minimum volume of business. So after seeing this parameter, the exchange will allow the market makers to work. Market maker may compete with other market makers for better quote to the investors. So there can be a competition also. Once registered as a market maker, he has to start providing quotes from the day of listing or the day when designated as market maker for the respective script, and shall be subject to the guidelines laid for market making by the exchange. Next point, once registered as a market maker, he has to act in that capacity for a period as mutually decided between the merchant banker and the market maker. So what is the period? Period will be mutually decided. Further, market maker shall be allowed to deregister by giving a 1 month notice to the exchange. You say single 1 lakh rupees for single script. That is written in the next line. However, the investor point is investor with holding a value of less than 1 lakh shall be allowed to offer their holding to the market in that script, provided that he sells his entire holding in that script in one lot along with a declaration to the effect to the selling broker. So it will be one script 1 lakh rupees, but somebody wants to sell below 1 lakh, all his scripts that he is holding has to be sold. For one investor, he can take 1 lakh. At least it should be 1 lakh, but in exceptional cases, it can be less than 1. But suppose another investor, he can also sell. So 10 investor can approach him in a day with 1 lakh rupees. Okay. Now come to one important thing. This market maker is not very important, because generally you will not come across this in the day-to-day discussion also. But this SLBM is there in your SFM syllabus also. When do you use security lending and borrowing mechanism? Tell me from your knowledge of SFM. In derivative, for buying or short selling. For short selling, you expect that the prices will fall. Sell now, purchase later. Okay, but how do you sell? You don't have security. So therefore you can borrow security from others. So stop borrowing, or from one party stop lending. So sell it now at a higher price, purchase it later at a lower price, return the share to the first party from whom you have borrowed. Of course, you have to pay him interest for that period or stock lending charges for that period, and all benefits that has accrued during this period will also have to be transferred to the first party. If any dividend has been received by you, that also you have to transfer to the first party. Okay, so that is SLBM. SLBM makes short selling possible. Without SLBM, short selling will not be possible. Okay, in India, SLBM started I think around 2008 only. It was not there from the very beginning. The purpose of SLBM was to ensure more and more liquidity in the stock market and reduce the speculation. Okay, so let us read now. You got some background. Security lending means lending of stock, derivative, and other securities to investor or firm. Security lending requires the borrower to pledge whether cash, security, or a letter of credit to the lender. Now see, this is suppose one Mr. A, and this is suppose B. A has lot of shares with him, but he does not want to trade in those shares. He is a long-term investor. So instead of keeping the shares idle, he lends the shares to Mr. B. But then there is a risk that Mr. B will not repay his share. So normally Mr. B will have to either pledge security or pledge a letter of credit, etc. to the lender. Between A and B, usually there will be a intermediary. A and B may not know also each other. A will just lend his share to intermediary, and that intermediary will lend shares to B. And B will deposit some collateral with the intermediary as a guarantee that B will return the shares back. Okay. So the security can be government bond, bank FD, or it can be a letter of credit, means guarantee, or it can be a guarantee also, bank guarantee. When a security is lent, now what do you mean by lent? The title and ownership are also transferred to the borrower. There is nothing called lending a share. I can lend my mic to you, but I can't lend my just share to you. I have to transfer the title and ownership rights to you. You have to get the share transferred in your name. Then only you can sell. Is it right? Why security lending and borrowing is important? Short selling is possible if there is a security borrowing and lending mechanism. Okay, because then many people, they expect that prices may fall, but they don't have necessary number of shares to sell. Use this mechanism. What is short selling? Short selling is a facility in which a person called short seller can sell the shares which he does not own or possess. How is it possible? By borrowing the shares. Okay, which is allowed in India. But again, there is a complicated mechanism which you have to follow. Now, what is the benefit of short selling? Why would short seller do that? The short seller borrows securities to immediately sell them. Why? Because he has a firm belief that the security price will come down in the near future. Okay. So A will lend his share to B. B will sell it in the market. Suppose B sells at 100 rupees in the market. Later on, market price falls to 50. He will return the share back to A. 100 minus 50. 100 is the price at which he sells. 50 is the price at which he buys. 50 rupees profit minus any stock lending charges, interest, commission, okay, guarantee commission, etc. So that net profit will be still very high. So he borrows security hoping to profit by selling the security and buying it back at a lower price. Short selling, as you know, is very dangerous. It can backfire. It can boomerang. Because if the price rises, you will suffer loss. The borrower of the security, means Mr. B, pays the lender Mr. A, the interest on the value of the security borrowed. So Mr. A also is happy. Instead of keeping the shares idle, he gets a chance to earn some interest, which is called stock lending charges. Now next is, who are the borrowers of the security? Who will borrow the security? Brokers, speculator like you, market makers, custodian banks, clearing corporations, and finance companies. So those who need to sell, those who need to give shares, they will borrow shares. Is it printed in your notes? The lenders, who are the lenders in your notes? Mutual fund. Because mutual funds are generally long-term investors. Then insurance companies, they have huge number of shares lying idle with them. Custodian banks, finance companies, brokers, high net worth individual like you, who have got a lot of shares, instead of keeping idle, want some money out of it. And you have all the benefits. The lender still remains the owner of the stock after SLB and gets all the beneficial rights, such as dividend, rights, bonus in respect of the stock lent. So all the benefits that will accrue to the owner of the share will belong to the original owner, that is the lender. The borrower of the share will have to compensate any dividend, bonus, share rights during this period. The borrower, however, has the legal title of the borrower security. Because unless you transfer the legal title, he cannot sell the share and is eligible to trade and sell security in any manner if he thinks fit. Moreover, there is a rollover facility also. What is that? The lender and borrower can extend the period of their borrowing and lending respectively. So earlier it was for 1 month, they might extend it for 1 more month. This question they have asked in the exam, in the earlier SFM exam. What are the merits of stock lending and borrowing mechanism? So these are the 6 points. First is, if you want to sell short because you expect the price will fall, benefit from this, you can use this stock lending and borrowing mechanism. Then there are a lot of investors like mutual fund, insurance companies, high net worth individual who hold shares for a long term. They are not interested in trading in those shares. It gives them an opportunity to earn additional income by lending the shares. So even from their idle stock, they earn some interest or stock lending charges, and they continue to be the owner of those shares because they get all the benefits of the share. Why SLBM was allowed in India? To increase the liquidity so that more and more people can sell and purchase the stock despite shortage of money. Next is it provides stability to the stock market movement. More and more settlement can take place now. Okay. However, to avoid delivery failures, as it is routed through the helps to avoid delivery failure. Sorry, as it is routed through clearinghouse and facilitates timely delivery. A and B will not meet directly. It will be routed through a clearinghouse or an intermediary so that the transactions are executed without any delivery failure. And lastly, manipulation of stock prices is difficult. That is a subjective statement. In India, people can do anything. Just give them a chance. Okay, they can make lassi out of washing machine. Yes or no? Straight through processing, STP, tick mark. Now this is something really interesting and important. Whatever you have learned earlier will soon become outdated, because now so much of technology has gone into stock market that there is no human intervention. There is no human intervention. Okay, what you learned, clearing house, clearing bank, custodian, NSCCL, gone or will go, because this technology called STP, straight through processing, is designed to complete the transaction without human intervention. That means you purchase the share, you'll get it. And in between, no human intervention will be involved. The technology will do everything that is required in that whole process. So what will be the benefit? Less labor cost and time will be saved. Speed and cost reduction and accuracy also. Because if the technology is properly tested, it can't make mistakes. STP is an initiative that financial companies use to optimize the speed at which they process the transaction. In your bank account also it happens now. You have to transfer money from one account to another account. Is there any human intervention except you have to place just some basic information? Okay, show your mobile phone to that UPI, what you call it, QR reader, scan, press OK, transfer. Huh? You have to put amount also, of course, but imagine the time that you used to take earlier and the time that you take now to transfer fund has gone down a million times. Okay, to make a demand draft for institute for my foundation exam, first I have to get up from my home, wear reasonable clothes because I am going out, go to the bank, take a form, fill that form, then stand in the queue, pay the amount, again wait, again stand in the queue, take your demand draft, then go to post office, again stand in the queue, submit that, it will go to the institute office. Almost it was a 1 day program, okay, or at least half day exercise. Do we do that now? No. I think that DD has gone away for everything now. Yes, at least to a large extent that online system has been started now. 3 years ago is too long. 3 years ago is too long. Yes, yes. Now I think they don't accept any check demand draft. But still that option of online is there. Now if you don't want to avail, what they can do? If you don't want to enter into STP world, then it is your problem. Is it right? Even all those physical document submission etc. will also go away. But our institute is a little slow in adopting STP. Otherwise, it's not really required. So anyway, I'll come back to the topic. After a lot of criticism of institute, come to the topic. This is performed by allowing information that has been electronic entered into to be transferred from one party to another in the settlement process without manually re-entering the same piece of information repeatedly over the entire sequence of events. Once you put the original data correctly, second time data entering is not required. It is like, for example, you buy something from Amazon. Okay, data entry is only once when the customer buys the product. After that, the seller, the courier company, Amazon, customer, all get the same information. Is it right? There is no manual intervention then at any stage. Only when the courier company receives the packet, he has to just put a tick mark in that software that is given to him. So you get an acknowledgement that yes, my shipping has started. And when he delivers you again, he puts a tick mark, dispatch. The same information goes to everybody. That is also STP, minimum human intervention. And this will be very useful in the field of finance, especially in the trading of shares, etc., mutual fund, etc. The primary purpose of STP is to streamline the processing of transactions across multiple points. Only the technology has to be handled carefully, otherwise scope of manipulation, fraud is also there. By allowing information to pass along electronically, this eliminates the need for a hands-on re-entry of data that has already been completed at the source. So more and more business models are going to use this. Airline business, same thing. Once you put your data, then don't have second time entry of the same data at any level. When you purchase ticket on railway on that website IRCTC, they will make you put all the data, but then they don't have to re-enter every time. Is it right? So that is the STP. I don't know what they call it, but you can take that as an STP. Additional information could be sent to more than one party simultaneously if it is appropriate for the transaction type. So depending upon what is the transaction, the connected parties will get the required information. So STP is to eliminate costly delays during transaction processing period. Since manual assistance is not needed, there is no delay between one party receiving information and the other being able to proceed further. In the exam, if they ask you, either you copy from here if you don't have time, cost saving, time saving, no manual intervention, less prone to error. Multiple information can be transferred to multiple points. Okay, that is STP. This requires taking the time to accept and review the information, relying rekeying data as required, and then sending it forward to the next part of the transaction process. So all this is done now through electronic means. No need of re-entering or manual intervention. STP eliminates human factor, allowing an automated process to complete any step needed for a transaction to proceed. By eliminating these delays, transactions can be more cost efficient as they require less time to manage, This is particularly attractive to investor looking for a lower fees option. So maybe this will reduce the brokerage cost also in future. The brokers are not really required. Although the transaction will be through broker, but they are not doing anything. They will give you the terminal, you do the things and you will receive everything. Their role will become negligible. Benefits can be explained with the help of an example. Example is also there. In a manual trade, the broker issues a contract note, which is then passed on to the custodian or a depository participant. There are multiple data entries during the different stages of a manual trade, which make the process prone to errors, delays and manipulation. In STP, contract note is issued in electronic form and the trade is settled in computer, leaving almost no scope for manipulation. In comparison to manual trade, STP is quicker, risk-free, eliminates any failure in trade. So this is the note on STP. You will be able to write straight through processing, no human intervention. This is what is going to happen in every business operations now, like placing of purchase order, execution of orders. In our online education, customer or the student just have to decide which product he wants to buy. The moment he will make the payment, the lectures will be downloaded on his computer, notes will be downloaded on his computer. Okay, then we don't need to teach also after some time. Only once we have to record, right? Because the moment you make the payment, you start viewing the lecture. Like it happens in that Amazon video, Netflix. Do they come and help you any manual intervention? Moment you make the payment, watch the movie. Okay. Which is your favorite streaming site? Netflix, Amazon, Hotstar, Hotstar. Okay. Margin trading now. To day after tomorrow. So how many portion is pending? Oh, just 2 pages. No problem. We'll complete on Monday and we'll take the next chapter on Monday.